Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on stock options and restricted stock units, also known as RSUs. And we're going to come to it with you from a tax perspective to make sure that we don't create any problems going forward. And so perhaps you have a promotion or a change of a job. You might be at a new company, and part of the compensation package could include stock options. And so this is something that we see periodically, and Rachel probably sees more than often than not in taxes all the time. And so there's some misconceptions and some ideas and things to think about. So today we're going to dive into that and make sure that you're aware and know what your options are going forward. And so as we're in the tax season right now, I'm sure you're seeing a lot of tax returns and compensation packages. And it was interesting. We recently had a client come in, and last year in 2025, he received a lot of stock options, and those got exercised, and he ended up paying taxes and taking the cash. But we'll go into that because, once again, he thinks potentially that they withheld enough taxes, but we'll kind of dive. They
never do.
I know. We'll dive into that a little bit later. So let's start with kind of understanding the types of equity. So there's a few different types. One is the ISOs, which is the incentive stock options. And so basically, these are options that are granted to you, and there's no tax at the grant or exercise.
So they say.
Right?
So let's dive in about ISOs, because I'm pretty familiar with those incentive stock options, and they say, there's no tax on these when you exercise them, but what they're saying is there's no tax on them for the regular tax system. Yep. The surprise is that most people face later is if they exercise and hold them, there's something called the alternative minimum tax. And this really hit a lot of people back in the year 2000, 2001, and 2002 when the dot-com bubble burst, where a lot of companies, it was pre-IPO or initial public offering, and a lot of their employees were granted these incentive stock options. And lo and behold, they exercised them and went to go file their taxes. And you basically have two tax systems. You have the regular tax system, and then you have the alternative minimum tax system. And so the difference between what you could exercise for and what the fair market value of these options, they call that the bargain element, or they basically added that onto income for alternative minimum tax, and it
so
created.
Depending on how much you get, so if it's a small amount, potentially you may not be a big deal. But usually you were seeing larger.
We were seeing
quantities.
Executives and employees even receiving huge grants, and then when they exercise, they were like, oh, you're not going to pay any taxes, and lo and behold,
the AMT.
They got hit with this huge AMT, which basically is phantom income because you don't have. If you didn't sell the shares, you didn't actually get the money. You just had them sitting there, and you owned them. But then what happened was a lot of these companies that were tech companies back in the early 2000s, they tanked or went out of business.
And so they owed taxes on these shares.
On shares, they didn't. Wow. They basically went bankrupt, and so they paid taxes. And there's a problem with liquidity when you have incentive stock options. So that's what you need to plan for if you are granted incentive stock options. Is make sure that if you have a large amount that you're granted and that you exercise, that you're planning ahead. Talk to your tax person and let them know.
But ideally, it's supposed to be more tax favorable.
That's what they say.
So it depends on how many shares.
Yes, under the regular tax system. And so oftentimes with incentive stock options, what happens is that people want to hold them for a certain time period, for a year and a day after they exercise, so that they can actually turn around and then sell them, and they have long-term capital gain treatment. But if the company goes out of business, then you're in trouble.
Yeah, got it.
So
okay.
If you think your company is going to grow and you want to, you're going to hold it, then that makes sense. But just be careful you're talking to somebody if you actually get granted or if you take a job where you may be getting incentive stock options.
Okay. And then you have the NSOs, which is a non-qualified stock options. And so basically with these, when you exercise this, there's obviously the tax consequences on this.
Yeah, so these are stock options that I see actually, well, those in RSUs, which we'll talk about in a minute, but non-qualified stock options we see often. And what happens with these are when you exercise them, somewhat like the incentive stock options, you also have that spread between the strike price or what they're offering them to you for and the current value. So that difference, that bargain element, basically gets added to your W-2 income. So it is
that's
taxed.
Ordinary income.
It is ordinary income in the year that you exercise. And if you look at your W-2, if you have non-qualified stock options, you'll see a code V in box 12. And the other tricky part about this is if you don't sell them right away, you want to make sure that you bring this to the attention of your tax advisor, because not all of them know this. But in the year that you do sell, you want to make sure that you are adding that additional income that was added to your W-2 to the basis of the 1099-B form that you get. Because what I've seen in the past is that some brokerage companies don't add that additional bargain element to the basis, and then all of a sudden you're paying tax twice.
Yeah, interesting.
So you want to be sure that you're watching out for that if you have non-qualified stock options. And it's definitely not like the big surprise of AMT with ISOs, but you are paying tax right away, and you're paying ordinary income tax on them.
And then we have the RSUs, which are the restricted stock units. And once again, those are taxed as ordinary income. But I think people have the misconception that they're not going to get taxed on those shares.
Oh my gosh. And because what happens is oftentimes they don't realize that these shares, you're granted these shares and all of a sudden they vest and you have to pay tax on it. And you really have no choice. And it's taxable as ordinary income. And employees are told, guess what, we're going to withhold tax on them, or oftentimes what you have to do is you have to sell shares to cover the mandatory withholding. So you're selling, massive shares. So you're granted them, then it vests, and all of a sudden you've got just income upon income, and you have to sell shares to cover, which means more income. And the employer says, oh, well, we're withholding enough taxes for you, but they're not. Yeah. And so if you are a higher earner, you want to make sure that you are talking with your CPA, with your enrolled agent or practitioner to make sure that you're planning ahead, because if you wait until April, you're going to be in for a huge surprise, and no one likes surprises in April, unless it's the Easter Bunny.
Oh, there you go. I don't mind an Easter Bunny coming. Okay, so let's talk then a little bit about some of the hidden tax traps that we see then with some of the exercising some of these different types of stock options.
So we kind of went into one of them, which is the AMT, or the alternative minimum tax. And it's, like I said, it's basically two tax systems running parallel to each other. And if you do exercise the incentive stock options before your company goes public, you definitely, on paper it looks amazing, but later you're in for a surprise. So that's one of the tax traps. The other tax trap we see is the under withholding on RSUs, which is something that I also already kind of alluded to. And there is a default that most companies withhold at with restricted stock units or RSUs, and it is 22%. But I'll say that I don't see that
very often. Or maybe it's like 20%. Or they do something, but not enough.
They do something, but it's definitely not enough. And so I work with clients a lot that call in and say, okay, I just got a grant and it's going to vest. One vest is in April, one vest is going to be in October. Can you, they'll send me their pay stub. So that's what you really want to do, is have your pay stub available, send it to your tax practitioner. We're happy to help with that. And
well, it's interesting. We actually have a client that had some stock options from last year, and they came to us now in 2026. And so obviously it's a little bit harder to do the planning when it's after the fact, but now we can go back and say, okay, how much do we need to allocate for taxes? Because they think, or they've said they withheld taxes, but as we dig in and look, they probably didn't withhold enough.
One of the issues that you might be facing is they may be withholding at a flat rate. Let's just say it's 22%, which is what we actually looked that up because I don't know exactly what it is. But if you have other income, you have to factor all the other income in. So if you're married and you have joint income on your return, and so you have your W-2 income, your regular compensation, then you have your spouse's compensation, or maybe you're single and so you have your compensation. Then on top of that, you have the RSUs. If you have investment income, then you have that on top of it. If you have rental properties or businesses or partnerships or anything, all that income is on top of that as well. And so if your employer is withholding at a lower rate and you're in the 37% bracket, it's not going to be enough. Yeah. So you definitely want to be planning ahead and not just assume that if you do have withholding on your RSUs that it'll be enough.
Okay. And so kind of moving on to looking at, obviously you have these stock options. You've now accumulated more stock in the company. So the thing you should be thinking about also is how much concentration risks you have in one company. So once again, you're getting paid by your employer. Now you have stock that you have from the company. And the company may be growing and doing great. But once again, how much exposure do you have to one stock in your overall household of assets? And so that's something to consider and look at, especially when we're looking at your investments and putting investment strategies to work. But the other thing to look at too is, once again, depending on what kind of stock options you're getting, do you have to hold it for the year and a day, or what do we have access to, and then potentially, how do we diversify that? So there are some strategies and techniques that we help and can do for you here. But obviously, it's once again looking at how much we're working with in the company, and I think what happens is when you're with an employer, you're loyal, you're optimistic, and but the reality is you also want to make sure that if you have so much in one company, there's some risk there too.
Well, it's your paycheck and your net worth are tied to the same place.
Yeah.
So I have a couple of clients actually that they have the situation where they're earning huge paychecks, and they also have huge concentrations in the company's stock. And they want to diversify their portfolio, but a lot of the stock is from RSUs, and to sell it, it's taxable income. Yeah. And so they already have large incomes, and then they're getting granted, these huge grants. So it's very careful planning is what it takes, and, working together and figuring out, when does it make sense to diversify? When does it make sense to sell some of these? Because once you have the options, you want to hold it long enough so that they qualify for capital gain treatment. So you definitely want to be working with an advisor and planning ahead.
Well, and that ties into, we actually just did a webinar recently on kind of the importance of asset allocation, rebalancing. And once again, one of the items that came up was being concentrated in just one company. And so once again, when we look at kind of your strategy and plan and investments, how do those all tie in together, and what's the purpose? And so as you phase into retirement, potentially, you might need income or some other things with your money. So once again, if you do have a concentrated position, happy to review that and see what we can do to help you there.
And check in with your advisor.
Yes.
Don't wait. Don't wait until April 15th or the week before tax season is over to check in with your advisor.
So let's talk a little bit about some strategic planning opportunities. So before you exercise kind of stocks is when you really want to have these conversations.
I have clients who call in the office all the time who say, okay, like I said, I'm going to get a grant. This is when this is going to vest. This is when this one's going to vest. And can you run a projection for me? Let me know how much you think that I should have withheld. Oftentimes people will send pay stubs to me, and I'll review those through, and we'll say, okay, have them withhold, this percentage, and they change their withholding for one pay period. So a trap there is making sure if you do change the withholding for one pay period to withhold a lot, make sure you're changing it back so you're not over withheld either later. And because it's great to get a refund, but it's a free loan to the government. Yeah. And so that is your money. So you want to make sure you're planning ahead for those situations.
Okay. And so let's talk a little bit about when you have a job change or a promotion or compensation package change. Obviously, it is important to look at the vesting schedule, the dates, your exit strategy for some of those positions, or even the job. Like, what is your plan? Do you plan to stay there through the end of retirement, or what is your age? And so there's definitely some planning overall too. It's not only the tax part, the financial planning, but the investing and making sure all this goes hand in hand with your current job and your situation. And so these are the types of conversations that we help our clients implement. And so we know that obviously this doesn't apply to everyone, but for the most part, there are a lot of clients that do have compensation packages. And oftentimes they don't really understand how it works.
And it can be really exciting when you get the job offer and you're offered this huge compensation package, which includes equity. But there are definitely some steps that you can take ahead of time that will keep you on track with your taxes and will help you to avoid surprises. Yep.
So kind of a few kind of takeaways is don't wait until tax time.
Please don't wait.
Yes, to do your planning. A little more forward thinking, get some tax projections for some of your stock
options.
And
run the projections before you exercise, because it may not make sense to exercise quite so much, or maybe For instance, maybe you're in a sales position and you earn a base and a commission, and maybe your commissions are lower for the year, and that might be a good year to say, oh, okay, maybe I will exercise some, and because you're right below one tax bracket.
And then looking at having a plan that's diversified, so perhaps making sure your investments are diversified if you do have concentrated positions, and then coordinating with your financial planner, advisors, and tax advisors. And then obviously reviewing kind of long-term, what is your strategy to leave the company? Or if you do leave, what happens to your stock options? And so kind of looking at some of the vesting schedules there. So I know we covered a lot today.
And it's a complicated topic.
Yes. And so we're happy to be a resource. If you like to discuss your own situation, you can reach us at 760-692-5700. And we're happy to set up a call or an initial consultation with you. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.